So I was not born with a silver spoon in my mouth. I was actually born into a very poor family. And I was the first person to go to college, but I was exposed to entrepreneurship at the age of 11 because my grandmother unexpectedly had a sudden loss. Her husband of 50 years got stage 4 cancer everywhere. You name cancer, he had it because he did not believe in going to the doctor for checkups. He owned a construction company. He worked hard. He took care of his family. What was the use of doctors for him, right? But they also, being products of the Great Depression, didn't pay a lot of Social Security tax. And so there was not a large Social Security payment coming to them when he passed away. So my grandmother at the age of 64, me at the age of 11 at the time, we spent a lot of time together because she would take me to and from school because my mother was working. She had to find a way to make money. And so she started a small business selling collared sandwiches. And she would make them in the morning. We would leave school because back when I was going to school, we got out of school at 1:15. We would go sell them at lunch hours.
Hello and welcome to another episode of Your Business, Your Next Level. I'm your host, Eunicia Peret, and today I have in the studio with me Mike Milligan. He is an author, adjunct professor, and 30-year veteran, as he calls himself, of the financial services industry. And today, as you're listening to this podcast, you are in for a treat because we're going to talk about some big things that frankly get a lot of people in trouble. So listen up, because those might be things that either you've done, you've been proposed, and if you've not been proposed, chances are somebody will propose them to you in the future. So let's have a great time. Mike, welcome to the show.
I'm excited to be here. This is, I think, in our couple conversations leading up to this podcast, this is one I have been excited to come on and be with you. I guest on a lot of podcasts, but by far and away, talking about taxes and strategy with another tax pro, an investment person like yourself, is something I have been looking forward to.
Well, I have too, Mike. And as our listeners know, we are very, very selective on who we even bring onto the podcast, because you and I both know, and in our conversations prior to today, we were able to kind of look at what are some of the things that people are doing out there, and what are some of the things that CPAs, even financial advisors, have kind of dovetailed and dipped their toe in, because it's, to some, it's another source of revenue, and nobody's really thinking about how is ultimately the client exposed to that. And you and I are very much on the same page on that. And I don't get to have this discussion with very many people because, again, most of them come at it from the perspective of, but just look at it, it's really good. And I'm thinking, no, it's not. And if tax attorneys and CPAs that don't ever do taxes can't endorse those things, truly
Right.
in alignment to the tax code and not getting people in trouble, everybody should be cautious. So talk to us a little bit more about, how did you get into this line? And I know that today we're going to be talking about 4 to 5 quote unquote strategies that are sold that leave individuals exposed. Before we get there into that though, tell us a little bit more about you.
So I was not born with a silver spoon in my mouth. I was actually born into a very poor family. And I was the first person to go to college, but I was exposed to entrepreneurship at the age of 11 because my grandmother unexpectedly had a sudden loss. Her husband of 50 years got stage 4 cancer everywhere. You name cancer, he had it because he did not believe in going to the doctor for checkups. He owned a construction company. He worked hard. He took care of his family. What was the use of doctors for him, right? But they also, being products of the Great Depression, didn't pay a lot of Social Security tax. And so there was not a large Social Security payment coming to them when he passed away. So my grandmother at the age of 64, me at the age of 11 at the time, we spent a lot of time together because she would take me to and from school because my mother was working. She had to find a way to make money. And so she started a small business selling collared sandwiches. And she would make them in the morning. We would leave school because back when I was going to school, we got out of school at 1:15. We would go sell them at lunch hours. We would count the money at the end of the day and then go and pay bills in person to Bell Atlantic, to the cable company. We would go to the local water company and pay bills. And if there was something left, we would put them in Folgers coffee cans and store them in the kitchen because we were not educated. We didn't know what to do. But I started a ledger. I had a spiral-bound notebook, and I started writing how much we put in there. And one day we got to a point about a year later that I told Granny, we don't have any more room in the cabinets. And so we had to open a bank account. So I helped her with that. I read it. I got to know somebody in the bank who was wearing a suit. I liked a suit and I wanted to wear a suit, but the only other person I knew at that time who wore suits was a preacher man, and I did not want to be a preacher. So I naturally gravitated to this man, the bank branch manager, who for the next really 6 years, I would go make deposits a couple times a week after school, ride my bicycle down with a backpack full of some cash. And he showed me how to make deposits. He mentored me. He was my education into banking. And I asked him, how do I become you? And he said it involves college and education. And it's what I wanted to do. I wanted to be a bank branch manager until I got to college. And then what I learned is that there's a whole nother side to this game. The Wall Street side, the tax side, the real estate side. And I was addicted to this. I loved reading tax code. And I know that sounds very boring for people. I love reading contracts. I love looking at prospectus, but I love it because there's a lot of people who don't love it, like my granny. My granny worked because she had to make ends meet. But at the end of the day, she would have loved to have had a 400 or 500,000 pot of money available so she didn't have to work. So why I do what I do now is because I love it. But more importantly, I want to make sure to take care of somebody else's grandmother in the future. And so like part of our conversation today is how do we protect the grandmothers and grandfathers out there away from scams or away from strategies that aren't proven. And so I'm really looking forward to share what I know, with you and, the two of us combining and working through some of these together and your audience having, just a new appreciation for that there are professionals outside they may not know who have their real best interest in mind, who are real fiduciaries, not like a fake fiduciary or a fiduciary with only one part of your money. But we're here to literally, from our conversations, I know who you are. You have the best interest. You have the right mentality for helping clients stay protected and doing things the right way. And you and I align so easily on some of these topics.
We do, Mike, and I so appreciate that because I see a lot of parallels. Not necessarily with Granny. However, I had many of the big banks, big name brands in the banking industry in the United States were my clients in my prior
Right.
life. And one of the things that I vouched to myself back then was that I didn't know. I was in consulting. I never dreamt to be in anywhere close to financial services as an industry, as a working with the entrepreneurs. And what I vouched to myself was that if I should ever do it, careful what you say you're never going to do because you never know, was that I was going to put the industry on its head. And that's exactly what we did by focusing on some of the things that you talked about. How do we protect the money and the assets of individuals who oftentimes fall prey to? I love that you talked about the fiduciary. They fall prey to the individuals who are on the news, who are in advertisements that will say, they're a fiduciary. And because by law, they have to do the right thing, you have to trust them. I equate that to, would you go to a doctor that tells you that they're a doctor and just because they took the Socratic oath, they are the absolute best person out there, and that you should trust them because they took the Socratic oath so that, there's no way that you could potentially meet your end in their hands. That's not the case. And so just like you wouldn't trust a doctor, you wouldn't trust a physician just because it's their word against the world, people shouldn't trust some individuals in the financial services industry that are more about how do they build a portfolio versus how do we protect the money of the grandparents, as well as the business owners who are working hard, focusing on their business, the entrepreneurs that are looking at what does that bottom line look like and how do we enhance it. And oftentimes the way to enhance it is by identifying money that has been lost to most people that are looking at it. So let's dive straight in. What are some of those tax strategies that you've seen? And we'll have a conversation on those that have left or are leaving individuals exposed.
Well, one of the hottest topics that I've seen out over the last 3 years now is Roth conversions. And I'm sure you've seen the same thing. And the reason that became so popular is because the Tax Cuts and Job Act was supposed to mature at the end of 2025. And then it kind of got put on life support with the One Big Beautiful Bill. But really, what a lot of people have been doing on Facebook and other places have been saying you should convert now while tax rates are low. Well, then they took this thing to the next level. And there have been strategies that have come out when, basically where you could put money, traditional IRA money, into like a self-directed IRA. And then you could buy a company. You could devalue the company because it's illiquid. Do the conversion then because the value's low, and then reverse the transaction where the money has come through. And I'm sure you have seen some version of this along the way, correct?
I have. And when I first looked at it, I was getting goosebumps, not in a good way, because I'm sitting there thinking to myself, it's black on white. These people have literally put down black on white, ink on paper, whether it's electronic or printed out, to say, listen, we'll just devalue this company. We'll just devalue these assets. And on the other side, you'll be just fine. And I'm thinking, do you honestly think that the individuals who care for the fact that you're trying to evade taxes can't find the same document that was just publicly shared with so many individuals? It was ground shaking to me. Yet so many people fall prey to it. And these strategies are also not inexpensive. So on top of the fact that they come with fairly sizable price tags, some of them are being stretched out for years. So congratulations to these companies. Now they have those clients captive for a while. By the time somebody comes asking, Uncle Sam comes asking questions, those companies in most cases are nowhere to be found.
It's kind of like how I equate this strategy, this Roth conversion devaluation strategy out there, is I kind of equate it to like solar installation companies who promise you the dream and deliver the nightmare, right? So a solar company comes by your house, they put on solar panels, they tell you you're not going to spend, but you have this loan on it. And then by the time you're ready to sell your house with this loan, you got to pay the loan off. Or that company goes out of business because they're not really there to service what they are. The interesting thing about this Roth conversion devaluation strategy is there's no private letter ruling that I have seen from the IRS, and nobody who can produce one to me. And I go to a lot of national conferences. I'm at a lot of events with a lot of CPAs, and real CPAs cannot provide a document from the IRS that says this is an acceptable strategy, because the IRS wouldn't provide that document if you really think about it. Because for years, the IRS has been your partner in an individual retirement account or a 401k plan. And they're your partner because that growth, they gave you a tax incentive to put money in. You've allowed that money to grow all that time. Well, a partner doesn't want to be bought out of their share through strategy, right? They want their share. Well, the government shares taxes. Now, what I believe is going to happen with the people who have signed up for this scheme is that the IRS is going to find out about it 3, 4, 5 years from now. They're going to come to the individual and say, tell me how you got to this. The individual is not going to fully understand how they got to it. They cannot explain it. And the person who sold it to them is going to be nowhere to be found. And if you don't have it 100% buttoned up where you can explain it yourself, it's a strategy you should not do.
I 100% agree. And speaking of the private letter ruling, I'll have to tell you, when something like this, one of those types of strategies, crossed my desk, I immediately went to CPAs that we work with, many of them who don't do taxes. All they do is look at the tax code day in and day out, as well as tax attorneys, and said, hey, smells funny, looks funny, is kind of slimy, I feel. If there was a question, would anybody be willing to stand behind this? And every single person said no. And yet individuals, Mike, fall prey to this every day. We'll talk about at the end, how could individuals protect themselves? Because that's where companies like ours, that's exactly what we do, right? To help protect those individuals. But many people are thinking, oh, no, don't pay for service, don't pay for support, just go do the thing. And then later on, they wish that they could undo it because now it just cost them a whole heck of a lot more. What are some of the other strategies that you've seen?
So the second one, I want to stick in this Roth world for a second. This will be the only other one I've seen is, have you seen like Facebook posts that said, convert your IRA and pay no tax. Have you
Yes,
seen
they are everywhere.
everywhere,
And once
everywhere?
you start seeing them, you're going to be hyper targeted. So don't, if you're listening to this and you're thinking that they know you very well because you clicked on it, you looked at it, even if you just looked at it for a couple of seconds, and now you're in that hook and you'll get more and more ads looking just like that. It is not because you're hearing divine intervention. It's
Right.
because you're being hyper targeted, just so that.
Correct. There is the possibility, the remote possibility that you could do a Roth conversion and not pay tax on it. But let me explain what that situation would be. That would be somebody living only on Social Security with expenses so low that the individual could use their standard deduction to do the conversion. Because if you have like your standard deduction amount, right, to do the conversion, and all the only other income you have is Social Security, your net tax is effectively zero, right? So there is a possibility you could do Roth conversions with zero tax, but what the ads are promoting is the use of low return bonus annuities. So products that
Yes.
will pay your tax for you. But the reality is you still pay your tax. Like you pay the tax, but your account balance has gone up because you've gotten a 20 or a 25% bonus on an annuity. And I know you and I are on the same page with this. Insurance companies are in the business to make money, not give away free money. And so if you're getting such a large bonus on an account, that means the returns are going to be pretty abysmal going forward in the future. And so that's a strategy that I've seen that I don't know that I don't lose sleep at night over it. I know a lot of people are falling victim to this, but we have to remember that Roth IRAs, once money is in there, never taxed again, tax free to the beneficiaries, tax free from a standpoint of like withdrawals along the way. A couple of rules here and there you got to follow, like the 5-year rule, right? But tax free. And to me, when it's tax free on growth, withdrawals, and to the beneficiaries, that doesn't sound like you want to suppress the growth on that over time. Sounds like to me you want to like allow the growth to occur because then that's really generational money at play. So I mean that's one that like it doesn't sit well with me when I see that one advertised
No, and
online.
there are a lot of ways to have that conversation when it comes to how do you allow the money to grow in a way that's truly, again, for the benefit of the client. You mentioned products. Products should never be sold because they check a box. I call those
Correct.
one-trick ponies. And oftentimes individuals will come and will say, somebody so and so told me that I could do this. What does this look like? And it's like, let's look at the numbers. Because if you look at the numbers, they don't make sense. And if the numbers don't make sense, then why would you dive into that? Where things make sense because they make sense and you look at it from multiple angles and you stress test it and everything else, then fine. But that is not something that I hear anybody talking about, because if they got into that game, generally there's a lot of money to be left on the table for the financial representative. And they also are not in the business of losing money, leaving money on the table, or not meeting their quotas. On the
Right.
contrary.
Now, the one thing I will say about bonus annuities is they could have a purpose in somebody's life, right? Just like I told you, there's this situation where somebody can get tax free, but it's a very specific situation on a Roth. There's a situation where, like, a bonus annuity or a guaranteed income annuity may make sense for people. So I don't want the listeners to hear that Mike says don't ever buy an annuity. For everything, right? From CDs to Bitcoin, tokenization, right? They all can have attributes in somebody's portfolio, but you have to start with taxes in mind and then an investment strategy behind you. Because in investments, CDs to Bitcoin, they're just tools along the way. The strategy really comes first.
And that's exactly what I was saying, that even when, for example, we work with clients, sometimes they'll come with us with a cookie cutter approach of, hey, somebody said this, can you prove or disprove it?
Right.
That's where you have to look. You have to let the numbers talk to see where it
Right.
makes sense and where it doesn't, and what are the alternatives. That's not common practice, unfortunately, because it involves too much work and too much going back and forth. And it just, yeah, doesn't work.
Well, that brings me to like the other one I see a lot is real estate. Okay. Now there's a couple things that I see in real estate that have that this, I think this is going to be a great conversation, right? Because you and I talked earlier about real estate before we came on, but there's the whole idea of active participation Airbnb rentals. And okay, so I have a doctor, I have many doctors who are clients and,
Same.
making seven figures a year. And somebody along the way said, well, just buy an Airbnb in Florida or Las Vegas or Arizona, become actively active in it 100 hours, right? And then cost segregate the house for depreciation, put a couple of great things in the backyard, right? So people will rent it and watch what it'll do for your taxes. The way I describe it, man, that sounds pretty simple, right? It does. But the IRS doesn't quite look at it that way. Have you seen anybody come to you and ask you about that strategy at all?
I have, as a matter of fact, we too work with a lot of physicians and very highly compensated individuals. And one of our surgeon clients referred another surgeon friend of his to us. And the story in that situation was that they had worked with this particular financial group. They were doing taxes, they're handling their investments. And it got to the point where the physician said, hey, I'd really like to diversify. What can we do? And at that point in time, the financial advisor slash CPA, I love it when they try to combine both. It's like trying to, speaking in medical languages, trying to take a urology surgeon to do a heart surgery. But people just don't understand that you can't put the two in a box. Generally, like in 99.99% of the time, these two people will think differently 100%. Their brains
Right.
are wired differently. So coming back to the situation, he speaks with a financial advisor slash CPA, and he gets proposed with the same type of an investment. About 2 years later, we get introduced and we start, looking at what's happening with the portfolio. At this point in time, he had partnered with other medical friends of his, doctors. They bought multiple properties, and Mike, every single month, they were bleeding money. Even though the properties were rented pretty much 100% of the time, they were putting money out of their pocket every single month into those rental properties. And I'm sitting there looking at the numbers, and I said, the numbers just do not make sense. Why would you have gone into this? And the whole idea was, well, because it was positioned to us as a tax strategy. And I guess it might have worked to some extent. And by the way, if you're listening to this, cost segregation does not work in most cases. Not when you're dealing with a single family home or a condo. There are thresholds. There are a lot of different things that go into that. So just because it's being sold to you does not mean that it's going to come through on the implementation side. So that's one of the examples of, yes, I've seen it. I would never tell people to go into something like that because if the numbers don't work, who cares about taxes? If you're going to end up literally feeding this monster for the next 20, 30 years, there's no way you're going to get from underneath it.
That was well said, right? Because that is like the difference between a sales strategy and a pro talking about it. And so, like all the listeners who just heard that, right? That was well said. Like when it comes to this, because, a physician, right, understands something called informed consent. You give a patient the pros and cons of everything. When somebody is selling something, they always sell the pros only. And they forget to tell you the backside, like all the money you've got to put into the property, that cost segregation doesn't always work. So that's a great one. I have another one for you. Ready for this?
Always ready. Let's go, Mike.
Software depreciation. Have you been following this new amazing sold just to America? I almost feel like when I hear this one, right, it can work. Like it can work. But again, it's being sold like it's Necker Island, like the greatest vacation you could ever go to, right? And it's being sold to everybody. So, what people are saying is let's invest in AI nodes. Let's invest in the hardware, software of like AI. And let's really participate in these trades. And when you do that, there's a rule out there. Section 179 of the IRS code allows for like depreciation of software and other hard assets meeting certain criteria, and then allows you to bonus depreciate those sooner in a year. And what had happened is that code has got massaged and manipulated. And now it's like, okay, well, let's go out and buy this piece of equipment out here that with real money, you buy in something with real money that turns into a real depreciable asset on your tax return. But again, it's real money to reduce taxes. And a lot of times, like people are so engrossed, high income earners are so engrossed on the taxes now that they forget to look on like the return on investment on what they're actually putting their money into. And so, a reduction in tax rate for something like this may pan out to almost like a low yielding money market account, to be honest with you, by the time it's all said and done. But I mean, I'd love to hear your take on this
But
also.
listen, you talked about software depreciation in a context of nodes, bit blockchain nodes. There have been so many projects out there. And listen, if you're listening to this podcast, the likelihood that either yourself or somebody that you know might have lost minimums of hundreds of thousands of dollars, if not millions, is high. And the only people that oftentimes at times have made it on the positive side out of a lot of blockchain type of projects were the individuals that invested early. They let everything they let the wave ride, and then they got out. Those are the only people. However, is the equivalent of trying to time the market, except you have even lesser visibility into those things than you would in the market. So that's one. Be very, very careful. I can't tell you how many times I've been pitched into, hey, and this company, we've been around for 12 years. I kid you not. And they have all of these different types of projects on the blockchain. And what the word there is utility, right? Everybody wants to show that their blockchain has utility. And if the utility is simply because you have to buy and sell the nodes in order to get into whatever project, it's problematic. Unless that project is directly somehow tied to an asset, it's potentially a game. So please understand that. You're right, Mike, as you're going out there, that is a big thing. The other thing that I saw with software depreciation, this seemed to be kind of a fad even just 2-3 years back, was with companies that were selling the promise of, hey, if you buy this software, you kind of get to, use it for your business to prove that, to seeing my fingers, right, quote unquote, to prove that you're using it in the business. And then you get to do the bonus depreciation. Well, if you haven't really used it in the business and you don't have a solid case study, just because somebody told you that on paper it might look fine, it probably isn't. And this is where in our world, having seen what we've seen, it goes back to who are the people that you're talking to. Because the reality is that you're out there. I'm sure, Mike, you can speak to this and I can speak with this ad nauseum. There are way too many individuals that have discovered that they can be intermediary for some of those companies. And literally they'll show up at networking events proposing those strategies because they've made it into a business. That's
Right.
exactly how they get paid. That's how they get compensated. And you're on this other side thinking that you're getting something good, but it's not been validated. And to Mike's point, it's been sold to you. And anytime you're in a sales position, somebody wins, somebody sometimes has the opportunity to lose.
Well, this has been like absolutely amazing, right? To have this type of conversation between like you and I about this, because there's a lot of things that do work when at the end of the day. But like strategies that seem like overly complicated that are sold by people that seem like they're too good to be true makes, and it doesn't pass the sniff test. That's something that you need to bring like a professional in on who is active in this every day. Like, I mean, there's great things that work that, if we get positive feedback on this, maybe your listeners will say, I'd like to have Mike back and let's talk about the things that do work, right? Because there are a lot of great strategies that do work, like the use for entrepreneurs, the use of the Augusta rule, using bonus depreciation the right way. And then like one that my wife and I have implemented is moving to Puerto Rico and becoming Act 60 citizens. And so there are some things out there that really work, like through like by structure, by loopholes. But more importantly, there's some things like geographic arbitrage, like just living in the right place for your circumstances that could create amazing tax strategies. Because we both know this, and many of your listeners know this too. Taxes are the biggest expense you're ever going to pay in your life. But a
That is
lot of
very true.
people have found ways to make some of that expense optional. And through proper planning, structure, and knowing the tax code, you can have some of that optionality in your taxes. And so as opposed to like having a one size fits all, just budget this much for taxes, or just this one size fits all. I'll just pay whatever the CPA tells me at the end of the year. Tax planning is the most important planning you can do. And when it's done right, can create massive amounts of generational wealth, massive amounts of cash flow, massive amounts of growth in, if people are still in scaling or growth mode in their business.
100%. And yes, Mike, we should do a 2.0 to talk about the things that work. And in the meantime, as you're listening to this episode, I am asking you, and Mike has already asked you, we hope that this deserved a 5, number one. Number two, we want to hear from you. When you do your rating, please let us know in the comments, what is maybe even the one thing that really stood out to you or that was a big aha for you, because that'll give us visibility into what resonates, what doesn't, and then we can go from there and make sure that the discussion is tailored to what it is that you need to hear. Going back to what Mike said just a second ago about the different things that can be done, the location arbitrage, the way that you treat life, the way that you live life, right? Even by just living and where you live can make a huge difference. The reality is that there are a lot of different things that can be done. There are a lot of different strategies that, as long as they have a true approach, because they have a role in your life, they have a role in your business, they have a role in how you do things, they work. However, the biggest thing that I've seen is it really goes back to who are you surrounded with? Where are you getting your unbiased support when it comes to how do you decipher through some of those optionalities to identify the pros and the cons, which Mike, you articulated. I love pros and cons. We do that all the time. And you articulated so beautifully. Who is the person that's helping you look through the pros and the cons versus just telling you the pros because that is what they represent? You need to have the other side of the story so that you truly have a balanced approach to things. Mike, anything else before we conclude for today? Because we already dropped a ton of value to our listeners.
I would tell you, if you're listening to this and you don't have a true tax planner in your life, not a tax preparer. I mean, there's some tax preparers who can do some reactive stuff between that January 1st, April 15th cutoff, but not a lot. Tax planning is done in the year you are. So like right now,
December 31st.
That's correct.
December 31st.
That's right. We're sitting in the first quarter of 2026. There is no better time to do tax planning than today. And if you don't have that person in your court, you've got two of the best. And I will say that I'm one of the best. And I know Eunicia is one of the best. You got two of the best in the industry right here. Because one of the things that makes us the best is if we don't know it, we know somebody who does. That's our connection. That's our network. And we're happy to, just as we are going to rely on each other over the years now since we've met to do the right thing for people, we have others in our network that we can do the same thing for you.
Absolutely. And as a matter of fact, I will tell you, just to opine on that, is without the network, it doesn't work.
And you're right, it
doesn't work. Because the strategy isn't, you can't cook a strategy in a vacuum. You can't even cook it. If you're listening to this, I'll give you a really brief story. A couple of weeks ago, I was talking to someone who mentioned off air that he and his partners are setting aside 40% to taxes after everybody has been compensated. And I said, wow, how long have you been with your CPA? Because for you to allocate 40% to taxes for the size company that you are, in the industry that you are talking about, how do you run your business? You should not be thinking about paying 40%, especially in your growing periods. And he said, well, that's what we've always done. And listen, we're talking about a company. I'm not going to speak numbers because I don't want anybody to be offended one way or another. However, if you're listening to this and you found this insightful, just know that those same strategies are applying to you. Whether it's 40% or 35%, or you're having to scrape that when the tax bill comes or on a quarterly basis, it's still a lot. And it's not that we're not talking about don't pay your taxes. We're talking about what can you do to take what you wouldn't pay in taxes to reinvest back into your business, to reinvest back in your company, and frankly, even in the economy. So it's not about tax evasion. It's about true tax planning so that you can actually help benefit everybody and everyone else in the economy. So with that, and without further ado, Mike, thank you for being here with us today. Stay tuned and don't forget, we want those comments from you. We want to understand what stood out to you the most about this episode.
Thank you for joining us on Your Business, Your Next Level podcast, where it is all about helping you make more, keep more, and elevating your business to the next level. To learn more, make sure you head over to www.podcast.excelstra.com and don't forget to subscribe, rate, and review the show. Again, that's podcast.excelstra.com. Until next time, thanks for listening.